Hello everyone. In this video, we are going to understand the expense cycle from both an accounting and an audit perspective. Whenever a business spends money, whether it is for rent, salaries, utilities, office supplies, or services, all of that comes under the expense cycle. This topic is extremely important because expenses directly affect profit, cash flows, and financial statements. Auditors focus heavily on the expense cycle because even small errors here can significantly change reported profits. By the end of this video, you will understand not just what the expense cycle is, but how it works in real businesses and why auditors care so much about it. The expense cycle is one of the core accounting cycles in any organization. No businesses can operate without spending money. Every time a company buys goods, uses services, pays salaries, or pays utility bills, it is going through the expense cycle. The expense cycle contains two things: incurring costs and paying suppliers or service providers. A properly designed expense cycle ensures that expenses are necessary for business, approved by management, correctly recorded in books, and paid at the right time. This helps the business control costs and avoid unnecessary cash outflows. The main objective of the expense cycle is control. Businesses want to ensure that money is spent only for business purposes. No unauthorized purchases are made and no fake or duplicate invoices are paid. Another important objective is accuracy in financial reporting. Expenses must be recorded in the correct accounting period, in the correct amount, and under the correct expense category. Without a proper expense cycle, a company may face losses, fraud, or audit qualifications. Let's now understand how the expense cycle works step by step in practice. The cycle usually starts when a department identifies a need. For example, the admin department may need office stationery. First, a purchase request is raised. This request is reviewed and approved by management. After approval, goods or services are ordered, goods are received, and the supplier sends an invoice. The account department checks the invoice, records the expense, and then processes payment. The cycle ends when the supplier is paid and the liability is removed from the books. Each step exists to reduce error and prevent misuse of company funds. Source documents are the foundation of the expense cycle. Examples include purchase requisition, purchase order, goods received note, supplier invoice, and payment confirmation like payment vouchers or bank advice. These documents serve three main purposes: proof that the transaction occurred, evidence of authorization, support for accounting records. Auditors rely heavily on these documents. If documentation is missing, expenses may be disallowed or questioned during audit. The expense cycle affects all three financial statements. On the income statement, expenses reduce profit. Higher expenses mean lower profit. On the balance sheet, unpaid expenses appear as liabilities. Paid expenses reduce cash or bank balances. While on the cash flow statement, payments for expenses appear as operating cash outflows. This is why errors in expense recording can mislead users of financial statements. Internal controls are extremely important in the expense cycle. Some key controls include authorization before purchase, approval before payment, segregation of duties. For example, one person requests the purchase, another person approves it, another person records the transaction, and another person makes the payment. This separation reduces the risk of fraud and errors. Auditors test the controls to decide how much reliance they can place on the system. The expense cycle can be divided into clear stages: request, approval, receipt, recording, and payment. Each stage acts as a checkpoint. If any stage is skipped, there is a higher risk of unauthorized expenses, incorrect recording, and fraudulent payments. That's why auditors review the entire flow, not just the final payment. From an accounting point of view, expenses are recorded using journal entries. Typically, expense account is debited while accounts payable or cash is credited. These entries are posted to the general ledger and reflected in financial statements. Correct debit and credit statement is essential for reliable reporting and audit compliance. The expense cycle is exposed to several risks. Frequent issues in the expense cycle include recording expenses in the wrong period, duplicate invoices or payments, incorrect classification of expenses. There is a risk of fraud, overstatement, or understatement. High-risk areas require closer monitoring and review. These risks can directly affect profit and lead to audit issues. Strong controls and proper review processes help reduce these risks. From an exam and audit perspective, the expense cycle is a high-risk area. Examiners and auditors focus on cut-off errors, completeness of expenses, authorization and approval, and accruals and prepayments. Many exam questions are based on identifying weaknesses in expense controls and suggesting improvements. To conclude, the expense cycle controls how a business incurs and pays cost. It mainly involves expense accounts, accounts payable, and cash and bank accounts. Strong documentation and internal controls ensure reliable financial statements, better cost control, low risk of fraud and errors. A strong expense cycle is essential for both accountants and auditors. Thank you for watching this video. If this explanation helped you understand the expense cycle better, please like, share, and subscribe. I will see you in the next video with another important accounting topic.